Good morning, everyone. Welcome to the TradeStation Masterclass. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. And for me, it's always a pleasure to join you guys and talk a little bit about the TradeStation technology and how you can take advantage of it, especially in the areas of strategy testing, easy language programming, and technical analysis. Today is a strategy elements class. So we're going to focus on some strategies, not for not for the purpose of recommending any strategies, but just to help you understand what are the mechanics of strategy testing and how TradeStation performs the backtest. It's always good to have an understanding of this technology so that we don't get confused about a strategy's performance and how it could perform going forward. So before we get started, here's the usual disclosures. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and that past historical performance is no guarantee of future results. For additional information on these disclosures, go to www.tradestation.com/important-information. One of the things that I didn't mention was the title of this class. The title is The Truth About Backtesting Strategies on Price-Based Charting. A lot of times, we just do what's the usual, which is backtesting strategies on a time-based chart. For example, right now, I'm looking at a futures contract. This is the S&P 500 E-mini futures contract. And it's set to a daily time frame. So every candlestick here represents the trading activity of one day. I'm not sure, how familiar you are with, price-based charting, but these are charts that only react to price movements. The time-based chart that we're looking at, it's pretty much built based on time. So it'll just track the price movements for today, and they'll be represented in a candle, right? The peak of that wick will be the high of the day, and the bottom of that wick will be the low of today. And then you have the closing and the opening prices on the body of that candle. But every trade and all trading activity is going to be condensed in that one single candlestick. When you turn the chart into a price-based concept or technology, it's not keeping track of time. It doesn't care if it's 1 day or 2 days or 3 days, because it's not, as I said, it's not based on time. It's based on price. So the way that the chart draws is anytime that there's price movement. So you're going to see these types of charts as charts that are sensitive to price movements only. It could be weeks, and if the price doesn't move, if we're going through a consolidation period, or the symbol you're looking at is trading within a channel, you're going to see these price-based charts become very static, because they'll filter out all the noise that happens within, those small movements, and it'll only react to significant price movements. I do put the word significant in quotations because it's relative, and it's something that you as a trader, you are going to have to determine, what is considered a significant movement for a particular security. Every symbol, of course, is going to move differently. This one right here that I have on the screen, which is the futures contract, has its own way of movement. We may have a lot of futures traders here in class, but this topic of price-based charting applies to all asset classes, whether you're trading futures or stocks or options. You can build a chart based off price movements and then backtest a strategy on it. So this is a topic that I wanted to, bring up in masterclass, because a lot of times, we apply strategies to a price-based chart, and the results may seem that they're good, but there's got to be an understanding of how the price bars are built so that if those results can be trusted or not. I found in my own testing that many times the price-based charting strategy backtest it's unreliable unless there's a strategy that is designed around the way that the price-based charts are built. But let's go ahead and take a look at a few examples. That's the reason why we have this class here. We may have to go into the easy language code to create a strategy. That's something that's the topic of today's presentation, just for us to get our hands on the strategy trading technology and the back testing to see how we can test strategies on price-based charting. So let me go ahead and first of all, I'm going to go here to data and go to edit symbol. This is where you find the price-based charts, right here under select interval, you're going to see that the box is divided in two. There's a horizontal line right in the middle. The ones that are above that line are the ones that are based on time and the ones that are based on activity. So they're mixed together. Of course, the times are going to be second, minute, daily, weekly, monthly. It's a specific period of time. And then you have the tick and volume up here. Those are the top two that are activity-based or volume-based. Those are only looking at trading activity. So the chart will only move whenever there's the set trading activity amount that you specify, whether you're looking at, a 1,000 tick bar or a 1 million share bar, the chart will have to wait until that amount of activity has happened for the candlestick to build. But below the horizontal line, we find the price-based charting, and we have different styles. Those 7 types of price-based charts are charts that you can use. Everyone will build different. We'll look at some of the differences between them and how we can apply strategies to them. But let's go ahead and start with something where the one that is that started everything, which is the point and figure. This is the oldest style of charting that draws circles and X's based on price movements. Now, one of the things that we do have to specify here when we select point and figure is the box size. Box size is what you consider to be a significant price movement, and a reversal, which is what you consider to be a reversal. That's very subjective, and it's going to be different for every trader. Of course, the box size is also going to determine the frequency by which you trade. If you're filtering very small price movements, of course, the security that you're watching will have more opportunities to meet that size. For example, in the S&P E-mini, we know that this security is quoted at 4,983. For those that are futures traders and for those that are not, this is a security that trades in quarters of a point. So you can see that from 0.25, it shifts to 0.50 to 0.75. So the minimum movement is a quarter of a point. So if we leave the box size at a 0.5, we're just talking about 2 ticks of movement, which for the S&P E-mini futures contract is something that happens very frequently. We can sit here and see how it shifts 0.5 in matter of seconds. So if you do leave it at 0.5, of course, you're going to get a very active price-based charting because your box size is going to be hit multiple times. So the box size, of course, as I said at the very beginning, there is a direct connection between the box size and how frequent your strategy is going to generate orders. So think about that. A lot of times, what I do to have an understanding on how a particular security moves is I apply the average true range. Very simple indicator built into the TradeStation platform, but it gives you an idea on how much a security moves in average. If you're having a difficult time determining what the box size should be here, yeah, look at average to range. Let's go ahead and take a look. I'm going to go ahead and cancel out of this, and then I'll come back to it. But I'm going to go to studies and go to add study. And average to range is supplied with the TradeStation platform. All the studies are sorted in alphabetical order. So I'm just going to sort here or go to the A's, and you find it right here, average true range. By default, it's going to be a 20 bar average true range. It's going to measure, how big the candlesticks are. And you can see over here on the right that we get a size of 48. That's 48 points of movement average per bar. That's pretty impressive. You know, if we leave it at 0.5, of course, that's insignificant for a security that moves almost 50 points in average per day. Now, of course, you can choose, the size that you want. Of course, if you want to track the S&P E-mini at a 0.5 movement, it's up to you. Maybe you want that, sensitivity. You want that highly active strategy. But I want everybody to understand that the box size is going to, of course, have an effect on the way that the candlesticks are built and the way that, the bars are built. Let me go ahead and remove this average true range. What I'm going to do is think in terms of money. The S&P E-mini futures, every time that it ticks up or down, is a particular amount of money. For stocks, it's very straightforward. When it moves up a penny, you're making a penny if you're long. You're losing a penny if you're short. But those are the minimum movements on a stock. And if you have 100 shares and it moves a penny, that's going to be $1 in your favor. You just multiply. It's a straight multiplication between the number of shares you have and the minimum movement. And that's your dollar's profit, your dollar's loss. For futures, it's different. And if you're a futures trader, you probably know this already. But on the TradeStation charting, if I double click on one of these candles, it'll take me to the customized symbol dialog. So I can check the properties of the symbol. And you can see over here that for any futures contract, it'll give you something called the big point value. On this particular security, it is 50. 50 is the dollar value for every point movement of the security. That's a big point. We're talking about a whole point. We already said that the S&P E-mini trades in quarters of a point. That is reflected right here. You see the minimum move is 25 times the price scale. The price scale of the S&P 500 is on a 1/100th scale. When you look at the decimal places, you have 2 decimal places, and that's why the price scale is set to 1/100th. If you multiply that 1/100th times 25, you get the minimum movement, which is 0.25. Now, the big point value is $50. So if we multiply the big point value times the minimum move, you're going to get about $12.50, $12.50 for every minimum tick of the S&P 500. So yes, every minimum tick has a specific value on all these futures contracts. On this particular one, it's $50 for every 4 minimum moves, which make up 1 point. 4 quarters equals a point. So every point that it moves is going to mean $50. If I set this to a 5-point box size, I'm looking for, a movement of $250. If I'm thinking about the dollar movement, I can do that math and say, okay, a 5-point movement in the S&P 500 represents about $250 of movement. That every futures is going to be different. Every futures is going to have a different big point value. So if you want to find out, just go to the properties of the symbol and you can find that information in there. Let me go ahead and cancel out of this. I'm going to go to data and go to edit symbol. All right, I'm going to go to point and figure. Let's set the box size here to, doesn't really matter. I'm going to set it to 5 and then reversal 3. The reversal is interesting because on a price movement chart like this one, a reversal, it's a factor. It gets multiplied by the box size. A reversal is 3 times your box size. So what you're looking for is for the security to move, in this particular case, 5 times 3 is 15. So you're looking for the security to move 15 points in the opposite direction for you to have a reversal. A reversal is very visual in a point and figure, and we're going to look at it right now. So let me go ahead and set this to 6 months back. Actually, yeah, 6 months is fine. 6 months back. For this chart, I'm not going to use tick chart because tick charts take a little bit of time to load. We're going to go over to another type of price-based charting in a moment, and we're going to see how we cannot change it to anything higher than tick. But on this particular case for point and figure, I can use minute time frame, which is the underlying data that's being used. So does not confuse the time frame here to a time-based chart. This is still price-based. It's still monitoring the movement of 5 points times 3 for the reversal. So the time here is the way that the point and figure is going to look at historical data. The historical data, it's going to be split up into 1 minute segments for the point and figure to see where the prices went. So every 1 minute, it'll see how far up or down it went for it to determine whether the chart will move or not. That's the only reason why there's a time component here inside the price chart, just to build historical bars. So let me go ahead and do, I don't know, let's do months back. I was doing 6 months back just as a test, and I'm just going to click OK here. So it's going to look at 6 months of historical data on the S&P E-mini 500 or S&P 500 E-mini. And here we go. So you're probably already familiar with the way that point and figure looks, but when you see a column of X's, that's when the prices are going up. And every X represents 5 points of movement. Whenever you see a column of O's, of course, that's when the strategy is heading down, and every circle represents 5 points of movement. Of course, when the price goes in the opposite direction, we already said this, by 15 points, that's the point at which we got the switch from a column of X's to a column of O's, or from a column of O's to a column of X's. So that determines, when one column ends and the other begins. By looking at this, you're looking at a point and figure chart, and you may think, well, if I design a strategy, and this is where a lot of traders are developing strategies, really don't understand the way that the price-based charts are built and the way that the strategy, behaves in reference to it. And you may find that if you design a strategy that looks at these price-based movements and take advantage of that, you're going to have an almost perfect strategy in the sense that it's going to follow exactly what you're telling it to do. Now, realistically, of course, that's never going to happen going forward because there's no perfect strategy. Let's go ahead and take a look. Let's design a strategy that takes advantage of this. So let me go over here to my easy language development environment. And we're going to do something really quick. You're going to see how cool this is. I'm going to go to easy language. And let me go back here to the chart to tell you exactly what my strategy is going to do. It's going to compare the closing prices of each one of these columns. Of course, if the column of O's is going down, the closing is going to be at the bottom. And if I'm looking at a column of X's, since the price is going up, the close is going to be at the top. That's the nature of the point and figure. Of course, you can click on the background and go to the data tips window and see the difference between the high and the low and see where the closing price is. But what I'm going to do is I'm going to look at the closing prices here. So if I get a close that is less than the close of the prior bar, this is the case, I'm going to go long the next bar. Let's see what I can do here. I'm going to go here to my development environment. By the way, if you don't know easy language, we do easy language classes. If you're going to be a strategy developer, you must learn easy language. Of course, TradeStation offers strategy components that you can test out of the box. But if you're going to start combining ideas and creating filters and conditional orders, you're going to have to learn a little bit of easy language. You don't have to be a full-blown programmer in order to develop a strategy, because you can just write simple commands and TradeStation will react to those. I'm going to go here to a new strategy, and I'm going to call this at MC point and figure. This is going to be a simple strategy that it's going to say if, let's try if the font size here is big enough, but I'll make it bigger so that it's easier to read. I'm going to say if the close is less than the close, and the way that we do historical references in easy language is with a bracket. So I'm going to compare the closing price of the current bar with the closing price of 1 bar ago, and that is going to determine my entry. So if we have lower closing price, then I'm going to buy next bar at market. That's my command. If the condition is true, buy next bar at market. And my other condition is if the close is greater than the close 1 bar ago, then sell short next bar at market. By the way, that sell short can be one word or it can be 2 words, doesn't matter. They both come up in blue. If you've been to some of my easy language classes, one of the things that we explain is that anything that comes up in blue, like any word that comes up in blue, it's because it's recognized by the language, and easy language knows exactly what it is and it'll just act upon it. Let me verify this strategy. And that's it. This is my strategy. You can see that it's not complex. So when I say that you can, learn a little bit of easy language to be able to modify some conditions and create orders, it's exactly that. Let me go ahead and put that strategy on my chart and show you what it does. Studies, add strategy. And I'm going to go here to add MC, point and figure. All right, what's happening here? Well, you can see that, yes, the strategy identifies every peak and every trough, every high, a perfect high and a perfect low, and it's going to generate entries at each one of these tops and those. Historically, you pull up a chart like this and it's going to be perfect entries for all trades. If I go to my strategy performance report, it's going to look a little bit odd because it has no losses. Every time that you pull up a strategy performance report, of course, you see some red and some green. Here, everything is white, and we have some NAs, like the profit factor says not applicable, because profit factor can only be calculated if you have losses. And you can look at the strategy that has a gross profit of $400,000 and has 0 for losses. If you've been trading for a while, you know that this is absolutely impossible. However, notice how we were able to build a strategy and put it on a chart and look at strategy performance report and get some results. And we always repeat, this in our disclosures, and we repeat it here in all our classes, that anytime you see a historical performance, there's no guarantee that the strategy will do the same going forward. And those are things that we need to be aware of. Here, if we go to the performance graphs, take a look at that performance. A perfect 45-degree angle shooting to infinity. One of the things that I want you guys to remember, and this is the basis of this presentation, is that what you see in a chart is not exactly how the market behaved. Because you may be sitting here, well, this is exactly how the point and figure is built, all the X's and all the O's. For example, right now on the current candle or the current column, I see a column of X's. So I know the prices of the S&P futures is going up. So every time that it goes up by 5 points, it's going to just add another X. And if it hits my reversal, then that's when it switches over to a column. But one of the things that you have to be aware of, and this is something that the strategy doesn't reflect, is the following. Let me go ahead and open up my chart here so you can see what I'm trying to say. On this reversal, when we were on this red column and it switched over to a column of X's and the prices started coming up, it's when it met the reversal. You guys remember the amount of the reversal? It was 3 times our box size, which is 15 points. So imagine that you were at this point, which is the very low of this column, the prices were dropping, and all of a sudden it meets the reversal. But the reversal, it's not going to happen exactly where this X is. It's not going to happen where the strategy thought the entry would have been generated. No. If we specify the reversal to be 3 times the box size, it's going to wait until 3 X's happen. So it's not until this level that the strategy would have been able to meet the reversal, and the prices would have been already higher than they were down here. So it's an unrealistic profit. Take a look at what's happening right now. Everybody sees that red dash against the green column. That is my reversal. Notice where the prices are. It's not going to reverse, and I'll be able to have a short entry all the way at the top. Of course not. It's going to wait until it hits the reversal, which is 3x lower before it can go short. So you can see that all these entries are all incorrect. Visually, of course, it gives you a perfect back test. But in reality, when you start building these price-based charting, then you see the behavior. This reversal is not hit until the price is lower or higher. That's exactly what the point of this class is, just to make sure that you understand that when you apply a strategy like this on a price-based chart, then sometimes what you see is not what you get in the real world. So let's go ahead and take a look at another, even though you have this perfect working strategy, notice how beautiful that is. It doesn't mean that you cannot apply a strategy to this, but you just have to be aware of the behavior and how it's reacting to those technical indicators. If I go here and add something simple like a moving average, this is built in, nothing custom. Okay, we have our moving average, and let's say that we add our strategy. So the strategy, let's just add something that's built in, moving average, long entry, and moving average, short entry for the moving average cross. Okay, we can see that we have some winning trades, but this strategy doesn't do very well when we have a consolidating period, or when the market is moving sideways. You can see how the moving average is just going across these columns, and you're getting flipped back and forth between short and long, and these are all consecutive losing trades. You can see that they're all connected with the red line. If I go here to the data and I go to strategy performance report, again, notice how we have a perfect 45-degree angle, but in the opposite direction. So if it were to trade this strategy going forward, you lose everything that is in your account based on the signals. Again, take a look at what the strategy is doing. The strategy sees that this column of O's crossed the moving average, but notice where the close is. The closing of the column is further down. It's not really when it actually crossed up here. So again, it doesn't quite generate the entry as you would have expected from a moving average. And also take a look at where the entry is of this short entry. The same problem with the custom strategy that we created, where the entry is on that first X right there at the bottom, when in reality, the price would have been already up here, and that's where the real entry would have been generated. So hopefully this makes sense, because yes, you're going to see a lot of conversations and a lot of discussions around strategies on price-based charting, but understanding how the prices move and how the price-based charting is building these columns or candlesticks is going to be crucial in your understanding of a strategy. Another price-based charting that, let me go here and change this. Let me go ahead and remove my moving average. Another price-based chart that I've worked on, just to see what the behavior of a strategy would be on its candles, is Renko. Let me go here to data and go to edit symbol. Renko. Again, Renko, we have to specify a brick size. I'm going to set the brick size to 5. Again, 5 would be $250 movement on the S&P E-mini. I'm going to do 6 months back. I'm doing 6 months back because there's no time component that I can choose. This is using one tick interval, regardless of what I want, because that's all that it uses, tick interval. I'm going to go here and click OK. This will take a few moments to load, but just as a side note, remember that TradeStation only has 6 months of one tick data or tick data, if you continue to load that same tick chart on a daily basis, TradeStation will continue to accumulate tick data for you. So eventually you'll start, having more. You'll have, 7 months, 8 months, 1 year, 2 years, depending on how frequently you open up that chart and is able to save that data into your hard drive, then you'll have it there and you'll be able to load and backtest on more historical data. But on a tick time frame, we only have 6 months of historical data on all securities. I wanted to look at the chart so I can show you another strategy that I find very interesting, especially in a Renko chart, because a Renko chart, it's very visual in the sense that you can see the uptrends and the downtrend very clearly because the price removes a lot of the noise and a lot of the static that happens throughout the day. Throughout the day or throughout the days within a week or throughout the weeks, depending on your box size. I mean, I set a box size of 5 on this chart, but if you guys remember, we looked at the ATR of the S&P futures and it moved an average of 50 points per day. So maybe 5 points, it's still small compared to the movement of the S&P. You can see how long this takes, I had already, here it is. I had already loaded the one tick data, before I started the class. So it loads a little bit faster, but still you can see how long it takes for the chart to load all those 6 months of historical data. But this is how the Renko chart looks. And it looks like stacked boxes. Every time that the S&P moves 5 points in either direction, you'll see a little box. Green boxes is when the price goes up 5 points. Every single box represents 5 points. And the opposite happens on a red. But you can see how clearly, it defines these uptrends and downtrends. So a strategy that I started thinking about was what if we look at the closing prices on these boxes and say anytime we have consecutive or 2 consecutive closing prices, 2 consecutive higher closing prices, I'm going to take a long trade. And anytime that I have 2 consecutive lower closing prices, then I'm going to take a short trade. That's the type of strategy that I was working with, and I wanted to test to see how it performed. Let's go ahead and go to the easy language development environment and set it up here. I'm going to go here to a new strategy. Similar to the point and figure, these are just going to be simple commands. I'm going to call this @MC, and this is going to be Renko. And my strategy is going to be the conditions to follow. If the close is greater than the close 1 bar ago, and the close 1 bar ago is greater than the close 2 bars ago, 2 bars ago, then I'm going to put the command down here, buy, buy next bar at market. And I'm going to do the other side. If the close, I'm going to do the other 2 consecutive lower closes. If the close of the current bar is less than the close of 1 bar ago, and the close of 1 bar ago is less than the close of 2 bars ago, then I'm going to say sell short next bar at market. By the way, easy language is not case sensitive. You're going to notice that sometimes I capitalize words, some other times I don't. Doesn't really matter. I capitalize words just for the purpose of readability. Sometimes it just makes sense in my head. But many programmers choose to type all in lowercase. You can also type everything in uppercase and scream your easy language at TradeStation. It's up to you. This is my strategy. Let me verify it, and let me put it on my chart. Studies, add strategy. Let me go to my @MCs, and this is Renko. All right, so here we have the strategy. You can see that on the 2 consecutive higher closes, we have a buy transaction. And anytime we have two consecutive lower closes, we have a short trade. If I go to the strategy performance report, it looks good. You can see the performance graph. Let me go to the performance summary. You can see the profit factor is not that, that great. It's 1.73. We still had losses in this back test. The gross profit, $158,000, but we had a $91,000 loss. And that's what, calculates the profit factor. But the thing is, and I repeat and I emphasize this point, we're looking at a historical back test and we're looking at historical performance. This is no indication or guarantee that this will happen going forward. First of all, markets move differently going forward than what they did in the past. Second, this is a price-based chart, and we know that a lot of the movements cannot be trusted visually. We looked at the point and figure, remember, and we saw that the reversal, it may seem like the strategy is able to enter at a particular point, but no. In reality, when it meets the reversal, the price is either higher or lower. So the entries are not accurate. The same happens here in my Renko, because there's movement here or movement within the days for the security that are not reflected on the chart. The chart is just building historically based on what happened to the prices, but in real time, the prices are going to move differently. For example, every time that you have an entry on this particular strategy, notice that there's movement in the positive direction. Every time we enter short, the short entry is at the top of the box. So the movement is down. So that's profitable. Here we have a long entry. Notice that it's at the bottom of the box, meaning that the prices are going up and it's a profitable. And if you check every single entry on this strategy, you're going to notice that every time the strategy enters, that very first box is going to be profitable. How many times has it happened that you enter a trade and it's always a winning trade? That's impossible. A lot of times, things happen and you start losing money. Another factor, let me go ahead and open this chart a little bit more so you can see what I'm talking about. Over here, we had the red box. I'm looking at the bottom. We have this green box close greater than the previous one bar. Then we look at the other one. Oh, this is the second close that is greater than the previous one and greater than the one before that. So this meets our condition. And we said, if that happens, then trade the next bar at market. So that's our entry right here. If this had happened in real time, yeah, the entry would have been generated right there. But there's no guarantee that this green box would have been here. If you enter over here, there's going to be movement up and down on this side of this green box. And the price is going to go up and down, up and down. Imagine the price coming down all the way down here instead. So instead of going up and creating this green box, imagine it going in the opposite direction. We're talking about in real time. If it goes down and then it builds a red box, that doesn't change your entry. Your entry is still up here because it happened in real time, and it happened because the condition was met on the prior box. So now we have a hanging entry right here that does not have this green box with it because the price went down and we're building red boxes in the opposite direction. So those are the type of behaviors that would happen in real time and not necessarily historically. Historically, the chart is, or the strategy is assuming that it has this perfect fill or this perfect entry. But in real time, this is not exactly how the price has moved. There's no guarantee that when I enter this long trade, that I'm going to have a green box. I could have generated a red box down here in real time. Historically, the strategy doesn't see that. So those are the type of things that I want you guys to think about when you use a strategy on a price-based charting. Always look at it and second guess and doubt the results, because most of the time there are going to be inaccuracies. If I go over here, notice something that I'm going to do here. I'm going to set a stop loss. Something simple. Everybody knows what a stop loss does. You know, it as soon as the strategy starts losing, then it'll just exit the trade. I'm going to set stop loss, set stop position. This word, set stop position, every calculation that I do on the stop loss is going to be based on the position. If I do set stop share, all the calculations are going to be based on a per share basis. So you have that choice of using this word instead of your code. I'm going to use position instead, and my stop loss is going to be something really, short. Set stop loss, and I'm going to put in parentheses $50. So if any trade goes against me $50, I'm going to get out. Does that make sense? Oh, before I make the change, let's go here to my performance report, because I want to take a look at something. We looked at this. We saw the profit factor of 1.73. If I scroll down, let me collapse the results here, because I see, largest winning trade, 6,500, and the largest losing trade, $500. So notice how the largest losing trade, when compared to the largest winning trade, there's a big difference. You would expect that in a trending strategy, but there's other things here happening that are not accurate. Now, let me go here to my easy language and verify this code. So I verify the code. Let me go back here to my TradeStation. Yeah, the stop losses are kicking in. Let me go to data, strategy performance report, and take a look at the results here. From a 1.73, my profit factor jumped to 8.39, which means that for every dollar that I lose, I make $8. I had a gross profit of 142,000 and only lost 16,000. Of course, that looks unrealistic, but a lot of traders may think, oh, this is a great strategy, but it's not. So be careful with, results like this. If I come down here, take a look at my largest winning trade is 6,500, and my largest losing trade is $50. Not only is my largest losing trade $50, if I go to my trade list, and let me open this up, take a look at every losing trade, 50, 50, 50, 50, 50. Every losing trade is exactly $50. Why? Because that's the stop loss we set. We set it at $50. And the strategy will just do exactly what you tell it to do. If you tell it to exit at $50, it'll do that exactly, regardless of what the market's doing. How likely is for every losing trade in your trading to be $50? Very unlikely. And if I go to my trade graphs, my performance graphs, you can see again that that characteristics of this performance that just shoots up in a 45-degree angle into infinity. So those are the things that I want you to always consider. Entries that are generated. This is what's happening on the current block. Take a look at that little dash that's going up and down. That's what's happening in real time. The strategy is going to be sensitive to that movement as well. And a lot of times, if this line moves down or moves up, that is not reflected historically. It removes that noise. But in real time, it does affect how the strategy behaves. And those are things that you have to be aware of. Of course, you can, use the built-in strategies that are on TradeStation on these charts just to play with the concept. But it's not until you have a full understanding of the underlying data and how it's being calculated and how sometimes what you see is not in reality what happened, is when you start saying, maybe this is not such a good idea. I know from experience that some have used price-based charting for strategies. I haven't been able to find one that provides good results in a real-time setting. You know, they all look good on paper. They all look great when I look at the performance report. But when you test them against the real time tick by tick, that's when the strategy just breaks down and you see the reality of things. Because the market, you know, those ups and downs that the price-based chart removes, you know, those price swings that get taken out, those still happen in real time, and they are going to be affecting the strategy in real time. All right, this is my class for today. Hopefully, you do get something about the way that price-based charting works when used with strategy backtesting. Be aware of the risks when you trade strategies on the TradeStation platform. Do not rely on a historical backtest for you to be confident about future results, because there's no guarantee that the strategy will behave the same way. In the contrary, is usually when you're using price-based charting, it'll behave exactly opposite as it did, you know, historically. So thank you guys for being here today. Thank you for joining the masterclass. Check out our events, the link right there that Manolo just shared, and for upcoming classes, and register if you want to. And again, thank you for your time. Have a wonderful afternoon, and I'll see you guys next time. Thank you for being here. Bye-bye.